insurance policies based on duration. Right. I hope the screen is visible to you all. Now, today's topic we are going to discuss regarding classification of insurance policies based on duration, that is based on the time. Insurance policies can be classified by duration into term life insurance covering a specific period and permanent life insurance that is lasting for the life of a period. Now, basically, the insurance policy based on the duration is meant for the life insurance policies. If it is covering for a specific period of time, that considered as term life insurance, and if it is considered for the end of a life of a person, that is considered as a permanent life insurance. Within term life insurance, there are various durations such as 5 years, 10 years, 20 years policies. Permanent life insurance includes whole life policy and other types of endowment plans. Now, these are the various types which we have already discussed in the previous sessions. Let me give you an overview of it. Term life insurance. This type of insurance policy provides coverage for a set period of 10, 20, or 30 years. That is, a specified period of number of years will be mentioned. Only for those years, the life insurance policy will be provided. If the insured dies during the term, the death benefit is paid to the beneficiary. If within the time period of insurance policy, if the insured party dies, then the death benefit will be received by the insurance policy holders' beneficiaries by the insurance company. Then another one is permanent life insurance. This type provides coverage for your entire life or until a specified age like 99 or 100 or till the end of the life of a person. This coverage will be covered. Then endowment plans. These policies offer coverage for a specific term and also provides a maturity benefit if the insured survives. So endowment plans means it coverages for the specific period and also provide the maturity benefits. That means it covers for a specific period of time, maybe 10 years, 20 years like that. Then after completion of the term, the policyholder will receive the maturity benefits. Then whole life insurance, this is a type of permanent life insurance that provides the coverage for the entire life as long as the premiums are paid. As long as the premium is payable under the whole life insurance, the life of a person will be covered. These are the classification of insurance policies based on the duration. Now, another set of classifications of insurance policies based on premium payment. Based on the payment of the premium also, the insurance policies will be classified. The insurance policies can be classified by the way premium payments are structured. This primarily involves the premium payment, frequency, and term. How frequently we are paying the premium, what term basis we are paying the premium. Based on that, the insurance policies will be classified. The level of premium remains consistent throughout the policy term, while flexible premiums allow for changes in coverage and payment methods. If it is a fixed payment method, the premium will be same, fixed throughout the policy. If it is a flexible premium payment method, then the premium and coverage methods will be keep changing because it is a flexible premium methods. Then under the classification of based on the premium payments, first one is premium payment frequency. Annually, if the premium is made once in a year, it comes under annual premium. If it is paid twice in a year, semi-annual premium. If it is paid 4 times in a year, quarterly premium. If it is paid every month, it will be treated as monthly payment. Another type of premium payments are regular, single, limited. Regular premium is paid throughout the policy coverage period. Suppose if it is for 20 years, throughout the policy period, if we are paying, it comes under regular premium. Single premium, if the entire premium is paid in one time, covering the entire policy term, we call it as single premium. Then limited premium are set for a specific period, but the policy continues for the entire term. The premium payment will be for the limited period of time, but the policy will continue with the entire term. That is called as limited premium. Then we have another premium structure, that is level premiums, flexible premiums. Level premium, it is also called as fixed premium, where the premium is going to be fixed throughout the policy's life. Whereas flexible, by the name itself, it is clear. Flexible, it will keep changing, adjust the premium amount and or the frequency. If suppose the premium is paid yearly, they can convert it into half yearly. If they are paying half yearly, they can convert it into monthly. So like that, premium payments amount can be altered. Even the frequency can also be altered in flexible premiums. These are the premium payment methods based on which the insurance policies will be classified. Then another set of classification of insurance policies based on participation in the profits. Insurance policies are classified into participating and non-participating based on whether policyholders share in the future's company profits. So based on the participation in the profits, the insurance policies are divided into participating policies, non-participating policies, which decides whether the policyholder have any share in the company's profits or not. Participating policies are known as with-profit policies because they are participating in the profits, and non-participating profits policies offer guaranteed benefits without profit sharing. Now let us see participating and non-participating policies. First, participating policies, we have profit sharing. Policyholder participate in the insurance profits typically through bonuses or dividends. That is profit sharing. Bonuses are added to the policy benefits, potentially increasing the payout amount. that is bonus, which is an additional amount which the policyholder will receive as a benefit. Higher premium due to the profit sharing aspect, premium for participating policies are often higher than non-participating policies. Because these policyholders participate, policyholders participate in the profit sharing of the business, hence the premium paid by these policyholders will be high. And risk mitigation, some investment risks are passed on to the policyholder, but they also benefit from the insurer growth. So in this participating policies, investment risks are passed by the policyholders, but at the same time, they are facing the risk. Along with that, they will get the benefit from the insurance company. These are the some of the elements we can see in the participating profits policies. Now, non-participating policies. Non-participating policies will have guaranteed benefits. Non-participating policies provide fixed premium and guaranteed benefits without profit sharing, without sharing the profits, but they will get a guaranteed a sum of amount as a benefits. Lower premium. As these policyholders are not participating in the profits, they are not getting any benefits out of the profits. Hence, the premium payment will be less compared to the participating policies. Predictable payouts. The payout structure is fixed and does not depend on insurers' profits. Now here, the payouts structure is, the payment structure is going to be fixed and does not depend on the insurers, that is insurance company's profits. Whereas in participating, whenever insurance company gets profits, the policyholders will get benefit. Whereas non-participating policies has no concern with the insurer's profit. Hence, the payout structure does not depend on the insurers, that is insurance company's profits. Focus on coverage. Non-participating policies primarily offer financial protection and are suitable for those prioritizing a fixed payout structure. Now, non-participating policies, their main objective is on the financial protection and are suitable for those prioritizing fixed payout structure. The policyholders who want to have a fixed payout structure and whose main aim is primarily on financial protection will go with this non-participating policies. This is about participating and non-participating policies as per the profits. Now, another set of insurance policies based on number of persons. Insurance policies can be classified by the number of people they cover into individual, family, group, and joint life policies. Based on the number of people, the policies are divided into individual, family, group, and joint life policies. Let us understand each clearly. Individual insurance, this type of policy provides coverage for a single person. As the name itself, it is clear, individual policy means it will cover only the individual person's life. Family insurance, also known as family floater insurance, this policy covers all members of the family under one plan. In one insurance plan, all family members' insurance will be covered. That is your family insurance. Then group insurance, offered by companies to their employees, providing a common health coverage to the group. In group insurance, mostly it will be provided by the organizations to its employees, providing the common health coverage to the group for the protection of the employees. Then joint life insurance, this policy covers two or more individuals and death benefit is paid upon the death of the last insured person. So this is joint life insurance where two or more individuals can be covered in that particular policy. Senior citizen insurance, this is a type of health insurance specifically designed for individuals over 60 years of age, considering their medical needs at an older age. One of the example is Bajaj Finserv. These classifications help insurance providers understand the type of coverage needed and offer appropriate options to individual families and organizations. These are the various insurance policies that are available based on the number of persons. Now it depends upon the person. If he is an individual person, he can go with the individual insurance. If a person has got a family, they can go with the family insurance. If already the organization is providing him the insurance policy under the group policy, then that will be covered in the group insurance, so on. Then another set of classification of insurance policies based on methods of payment of policy claim amount. Based on the how policy claim amount is paid, on that the insurance policies are divided. Insurance policies can be classified by the method of claim payment into lump sum payment or installment payment. Whether the company is paying the claim amount as a total in one-time payment or they are paying partly like installments. That is the classification which we can see in the policies classification based on the payment of claims. The first method we have is lump sum payment method, and the second one is installment payment. Lump sum payment, in this method, the entire claim amount is paid to the beneficiary or the policy holder in a single payment. In lump sum amount, single payment will be made by the insurance company to the policy holder. Installment method, it involves paying the claim amount over a specific period, usually in regular installments. Now, this is instead of paying the whole amount at a time, they will pay it in installments. Usually depends upon insurance type, including life insurance, health insurance, or property insurance. So, these are the two variations of insurance policies based on the policy claim amount. We also got other methods like Jeevan Rakshak policy, Jeevan Mitra policy, Jeevan Akshay policy, Bima Sandesh policy, the money back policy, children anticipated policy, progressive protection policy. These are some of the other types which also covers under based on the benefits that the policy holder received from the insurance companies. So these are the classifications of insurance policies based on the duration, based on the claim amount, based on the number of persons, and also based on participation and non-participation in the profits. Now let us continue with another concept called insurance premium. Insurance premium is the consideration money that a policyholder has to pay in lieu of the benefit that the insurer promises to confer on happening of the scheduled eventually. Now here premium is the amount which is paid by the insured party, that is the policyholder, to the insurance company, because the insurance company is promising to protect the life of a person, whereby in order to protect it, the policyholder has to pay consideration in return, and that consideration we call it as premium, that is insurance premium. Insurance is a contract, and the policyholder and the insurer are the two parties to the contract. Both parties have rights and obligations. Premium forms the obligation on part of the insured. So insurance is a contract where we will have two parties, policyholder and the insurance company. Now both are having rights and obligations. Premium is the obligation that rests on the part of the insurance policyholder. An insurance premium is the periodic payment a policyholder makes to an insurer for coverage. It's calculated based on the risk associated with the insured item or individual, the coverage amount, and the duration of the policy. Now, insurance is the most important factor in the entire life insurance policy. Now, premium calculation is also another important factor which we can see. Now, premium calculation is calculated based on the risk that is associated with the insurance policy holder, and depending upon the number of individuals the policy is covered, and depending upon the coverage amount and the duration of the policy, based on all these characteristics, the premium will be calculated. Along with that, the factors like age, gender, health, occupation, and lifestyle choices also influence the premium calculation. Now, premium calculation, in order to calculate the premium, this is a basic formula which we will follow, where premium is equal to risk factor into sum assured divided by coverage period. Now, risk factor, this reflects the likelihood of a claim and is usually expressed as a percentage. And sum insured is the total amount of coverage provided by the policy. And coverage period is the duration for the which the policy is valid. Then factors affecting premium. While calculating the premium, some of the factors need to be considered. The factors include first one, age. Generally, younger individuals have lower premium due to longer life expectancy. It is like vice versa. Lower the age, lower will be the premium. Higher the age, higher will be the premium. Based on the gender, historically, women have lower premium than men of the same age and health status. Health and lifestyle, pre-existing health conditions like smoking, drinking habits also increases the payment of the premium. Occupation, riskier occupations may result in high premiums. If any person is dealing with the high risk-oriented occupations, jobs, then they have to go with a high premium because the risk is higher in those jobs. Location, the area of residence can impact the premium as certain areas may have higher risk. Now, any person who is residing in a rural area may have the less premium, and the person who is residing in a metropolitan cities will have to pay the higher premium because of the high risk. Claims history. Previous claims can lead to the higher premium. The previous history, if the policyholder is having any previous history of claims, getting the claims from the insurance company, then they have to go with the higher premium. Deductibles, high deductibles, amounts of policyholders pay out of pocket can lower the premium. These are some of the factors that will affect the premium calculation. Then premium adjustment, we have experience rating. Insurers may adjust premium based on the policyholder's past claim history using an experience modifier. Based on the previous history of a policyholder, based on that, the premiums will be adjusted by the insurance company through an experience modifier. Then discounts and surcharges, premium can be adjusted for discount or surcharges based on various factors such as safe driving or group policies. So these are some of the premium adjustments where your premium will be either increased or decreased depending upon type. This is about premium. The factors that influence the premium, how we will calculate the premium, and the modifications of the premium in the insurance policy. Then another concept we come across in this topic is rebates. In insurance, a rebate is a partial refund or return of a premium amount paid by the policy holder. Now, say for example, if the policy period is for 10 years and for 5 years the premium is paid by the policy holder, and after 5th year, now the policy holder want to refund, want to return, want to get the premium, then that process we call it as rebate. It is either partially refund or return of a premium amount paid by the policy holder. Now, policy holder is requesting to return the premium amount which he already have paid to the insurance company, either partially or totally. That is called as rebate. These rebates can be offered under specific conditions or circumstances defined by the insurance company. They are essentially a form of discount or incentive to encourage policyholders to purchase or renew a policy. Types of rebates: large sum assured rebates offered for policies with a high sum assured or face value as administrative cost per unit of insurance decreases with larger policies. This is large sum assured rebates which offered for policies with a high sum assured or face value, where your administrative cost will be decreased with larger policies. Higher the policy amount, lower will be the administrative cost. Mode of payment rebates: discount for paying premium annually rather than monthly or quarterly. Rebates usually available for annual rebates. Rebate is not applicable to the monthly or quarterly period. Group insurance rebates offered for policies that cover a group individuals like employees of a company due to lower administrative cost and risk spreading. Now, group insurance rebates, group insurance is provided by the organizations to its employees. And if rebates are taken, the same way the employees of the companies will be given with these rebates because of lower administrative cost, and risk will be spread over the group members present in the particular insurance. High sum assured rebates, discount offered on life insurance policies with a larger coverage amount. The insurance policies, life insurance policies, which covers the larger amount, larger claim amount, that comes under high sum assured rebates. So this is about rebates. And the next topic we have is premium loading. In insurance, premium loading refers to an additional charge added to the standard premium, reflecting increased risk associated with certain factors like age, pre-existing health condition, or lifestyle habits. Now, premium loading is an additional charge that is made to the actual premium, standard premium, that is called as premium loading. That means your premium value will be increased, maybe because of the factors like the health conditions or lifestyle habits. The premium payments will be increased. Now, there are some factors that can lead to the premium loading, that is increase in the payment of premium amount. That is first one, age. Older individuals are generally considered to have high risk profile due to an increased likelihood of chronic illness, other age-related health issues, etc. Now, because depending upon the age, your premium will be loaded additionally. If older people will have a high risk because of the health issues, hence the premium will be added, extra charge will be added to the standard premium based on the age factor. Then medical history, pre-existing medical history, or a history of frequent claims can lead to higher premium, as these factors increase the probability of future claims. If any person is having a pre-existing health issue, health concern, health disease, or if he is going frequently to the health claims, then he probably has to pay high rate of premium. So that is because of the health medical history also, the premium will be loaded. Lifestyle habits like smoking or unhealthy habits can be considered as a risk factors. The high risk factors results in the high premium payments. Occupation, some of the professionals or some of the jobs are high risk oriented jobs, may be prone to have accidents or injuries, which also leads to the high premium payments. Family medical history. A family history of certain conditions can increase the individual risk and potentially results in loading charges. So these are the some of the factors which leads to the premium loading. Then another concept we have is rider benefits. Rider benefits in insurance are additional coverage that enhances base policy. Now, having a base policy, when we go with the additional coverage, then that comes under rider benefits. Providing extra financial support for specific circumstances beyond a standard policy. To the standard policy, if you are adding any extra financial support or any extra financial coverage we are adding to our policy, then that comes under your rider benefits. They are like add-ons that offer tailored protection for things like critical illness, accidental death, or income support in case of disability. So maybe because of these reasons, the present insurance policy will be added with some of the additional financial support benefits. Then in that case, the policyholder has to pay the additional premium to the insurance company. Such add-ons to the existing policy, we call it as rider benefits. Now it includes enhanced coverage. Rider expand insurance coverage providing financial assistance beyond the basic sum assured. As the rider benefits, it will have a enhanced additional coverage will be provided with the help of this rider benefits to the policy holder. Targeted financial support. Each rider is designed to address a specific event like a critical illness diagnosis, accidental death, or disability, offering targeted financial support during difficult times. So, rider benefits are mainly helpful to target the financial support provided to the insurance policy holders by the insurance policy company. Maybe it is in the form of accidental death or any kind of physical disability, or any critical illness is there. To have a additional financial support, the policy holder can go with the rider benefits. Customizable protection. Riders allowed to tailor insurance policy to meet their unique circumstances and risk profile. Now, in this, with the help of this rider benefits, the policy holder can alter their policy. The standard policy can be altered, can be modified depending upon their requirement, depending upon the risk profile of the policy holder. Financial stability. Riders can help alleviate financial stress during times of crisis. If the policyholder is facing any sort of crisis, disease, any sort of health disease, or any sort of accidental diseases or accidental deaths, then financial stability will be provided with the help of this rider benefits. Affordability. Adding riders to the existing policy is often more cost effective than purchasing a separate insurance policy. Instead of purchasing a separate insurance policy for a separate problem, it is better to go with the rider benefits to have the add-on policy to the existing policy. In this way, the cost will be reduced. So hence it is cost effective. Instead of purchasing a new policy to the same policy, with the help of rider, we can add our benefits more. Now, certain riders may be eligible for tax deductions, further enhancing the value of the coverage. When it comes to tax benefits, rider will have some of the tax benefits which are available to the policy holders. This is about rider benefits. Now, the next concept we have is surrender value. In life insurance, surrender value is the amount a policyholder receives if they decide to cancel their policy before it matures. Surrender value means surrendering the value or surrendering the amount of policyholder that is received, and this is possible when the policyholder decides to cancel the policy before its maturity period. Say, for example, the maturity period is for 10 years, but the policyholder decides to cancel the policy at 8th year, then that particular amount of policyholder receives at 8th year, we call it as surrender value. It is essential a payout of the policy accumulated cash value, taking out the account any applicable charges and penalties. As we are closing the policy before the due date or before the maturity period, hence the policy holder has to bear some of the applicable charges or penalties, and he will get the accumulated, the compounded cash value till the year which he has paid. Now, this surrender value includes surrendering a policy. This means voluntarily ending the policy before the insured death. Surrendering a policy means the entire policy itself they have surrendered before the maturity period, if it is a term insurance, or before the end of a life of a person, if it is a whole life insurance. Cash value. Most life insurance policies have a cash value that grows over time due to the interest and the policy savings element. Now, most of the insurance policy will have a cash value component, which as the policy grows over a time period, the interest and the policy savings element will also increases. Surrender value, as I told you, it is the amount which policyholder actually receives at the time of surrendering the policy. This is usually cash received, that is cash value, minus any charges or any fees he is paying towards the surrendering of the policy. Penalty: surrendering a policy early may result in penalty such as surrender charges or a reduction in the payout. Now we have two types of surrender value: guaranteed surrender value, special surrender value. In guaranteed surrender value, some policies offer a guaranteed surrender value, which is a specific amount the insurer will pay if the policy is surrendered at a certain point of time. If the policy is surrendered at a certain point of time, he will get a guaranteed surrender value amount that is called as guaranteed surrender value. Now, special surrender value is higher than the guaranteed surrender value and is calculated based on the present value and accrued benefits, that is outstanding benefits. So these are the two types of surrender values that are available. So this is about surrender value. Now the another concept we have is claim settlement. Insurance claim settlement is a process where an insurer pays out compensation to a policyholder for a covered loss or event. Now, insurance claim settlement is a process where the insurance pays out compensation to the policyholder. It is usually that is the closure of the policy at the end of the maturity period or at the end of the closure of the contract between the policyholder and the insurance company. Now, insurance company has to give claim amount to the policyholder. That process we call it as claim settlement. It involves the following process is involved in this claim settlement. First one, initial notification and claim filing. When the policyholder wants to get a claim amount, then first he has to do is initial notification he has to issue and he has to fill the claim form. The policyholder must inform the insurance company about the loss or event as soon as the possible. If any event occurred, if any situation occurred where the insurance policyholder is getting loss, then first he has to inform the insurance company as soon as he faces some situation, some event. A claim form needs to be submitted along with the supporting documents such as identification, policy document, and any event-specific certificates. If it is death certificate, or if he met with an accident, then medical records he has to submit. So the first stage is inform the insurance company first, then fill the claim form along with the necessary supporting documents. Then second one is claim investigation and verification. As the insurance company receives the claim form, now insurance company assigns an adjuster or surveyor to investigate the claim and verify its validity. Now, as the policyholder submits, as the insurance company receives it, immediately insurance company will appoint a adjuster or a surveyor to verify whether the loss that the policyholder is claiming is really up to the mark or not. They will verify the validity of the loss. They may gather information, review documents, and potentially conduct site visits or inspections. This is the second step. Then third one is decision and settlement. The insurance company assesses the claim based on the policy terms and investigation results. After the company receives the investigation results, they will verify the policy terms and conditions and the results. If the claim is valid and covered, the company will determine the amount of compensation to be paid. If after verification it is found that the claim is valid and it is covering the insurance policy, then the amount will be compensated and the amount will be paid to the policyholder. And the insurer may offer a settlement which the policyholder can either accept or reject. Then payment. Once the claim is settled, the insurer will make the payment to the policyholder or the beneficiary. If in case of a death of a policyholder, beneficiaries will receive the claim amount. Or if he is alive and having some accidental loss, then he will, as a policyholder, will become the beneficiary here. They will receive the policy amount. The payment can be made by check, direct deposit, or other methods depending on insurance company and policy. Then we have claim settlement ratio. The claim settlement ratio is the percentage of claims settled by the insurer in a given period out of a claims made. Higher the CSR generally indicates more reliable and credible insurer. So claim settlement ratio will explain how much percentage of claims he has settled during a particular period of time. That is insurance company. If the insurance company has got a high claim settlement ratio, it is understood that the company is more reliable, company is more credible in terms. This is the claim settlement process. Then till now we have seen the topics related to life insurance policies. Now let us see the topics related to the general insurance policies. We have something called soft and hard market in general insurance. Let us see what is this soft market and hard market in general insurance. A soft insurance market, which means rates are flat or decreasing and the insurance coverage are readily available. So soft insurance market here we means the rates are flat or decreasing. It will be less or decreasing in nature and the coverage is also readily available. By contrast, during hard market, when it comes to hard market conditions, the rates are consistently rising and the coverage is more difficult to find. So in this case, the rates will be increasing in nature and the coverage is more difficult to find out. All industries undergo period of market expansion and contraction, and the insurance industry is no different. Now, general insurance policies are given for the business or organizations or industries. Now, when it comes to business or industry, market expansion, market contraction, boom and recession, which are very much common. Even in insurance industry also, we can see this market periods. So while insurance rates for individual business are primarily affected by micro factors such as information of property locations or business operations, and there are several other factors that impact the price of the premium. Basically, soft or hard market can be defined as the changes in the value of the premium, whether it is increasing or decreasing in the general insurance policies. Now, when we can see soft market conditions and hard market conditions, in soft market, the insurance premium will be less. Increased competition among the insurance companies will be there. Relaxed underwriting criteria and broader insurance coverage period will be provided. Whereas in hard market conditions, higher the insurance premium, it is quite opposite to your soft market. Here it will be lower premium, here it will be high premium. Here the competition will be very high and in hard the competition will be very less because the premiums payments are high. And the underwriting criteria will be very low, whereas in underwriting criteria in hard market will be very high. And in soft market, the insurance coverage will be more broader, whereas in hard market, insurance coverage will be very less. That leads to higher deductibles. This is about soft market and hard market in the general insurance business. Now, in the previous slides, we have seen premium for the life insurance policies. Now, let us see premium in general insurance policy. A general insurance premium is the money a person or a company pays to an insurance provider for the policy, providing financial protection against a specific risk like accidents, property damage, or liability. Now, general insurance, there is no difference between the premium introduction, premium explanation with regarding to life insurance or general insurance. The only difference is in life insurance, it is meant for the life of a person, whereas in general insurance, it is meant for the organization or the products. Now, premium in general insurance will have financial exchange. That is, premium is the price paid for an insurance policy, essentially a contract between insurer and the policy holder. Then risk coverage. It is used to cover the financial risk outlined in the policy, such as potential accidents, theft, or natural disasters. Then when it comes to policy tenure, mostly general insurance policies are annual contracts. That is, it is meant only for 1 year. Like we have home insurance come under longer terms. Whereas home insurance, it is more than 1 year. Whereas other insurance like your vehicle insurance or travel insurance, it is meant only for 1 year. So this is the premium which paid in the general insurance. Then, like we have seen claim management in the life insurance, same way we have claim management in the general insurance. Claim management in general insurance involves the systematic process of handling and resolving insurance claims made by the policy holders. Now, this claim insurance policy management, claims management in general insurance, the steps are included. The first step is claim notification and documentation. The policyholder initiate the claim process by contacting the insurer, typically through a helpline or website. Now, after the policyholder go with the claims management, first he has to inform the insurance company. Then required documents must be attached and submitted to the insurance company with regarding to the incident with photos, videos, which can be crucial for verifying the extent of damage. Because general insurance is meant for protecting the products. Now, if any fire accident or if any theft happened or if any loss occurred due to the natural calamity, so such photos, such videos must be submitted. Now, second one, claim investigation and assessment. Even in general insurance also, the insurance company will appoint a adjuster or investigator, or we say him as a claims manager, who will verify the validity and the extent of liability. Now, after verifying, surveying the damaged property or vehicle, reviewing the supporting documents or any other relevant parties, after verifying everything, he will submit a report to the insurance company. Now, once the claim is deemed valid, once the insurance company and the surveyor decided that the claim is valid, then then the insurance company will give the payment amount, will calculate how much amount need to be provided, and the method of settlement, they will settle the amount. Fraud detection and prevention. Insurer that is insurance company employees will take various measures to identify and prevent the fraudulent claims, including data analysis, risk assessment, and scrutiny of documentation. And a proactive approach to fraud detection can help reduce the number of fraudulent claims and maintain the integrity of the claim procedure. Now, in this scenario, the policyholder, the insurance company will appoint the fraud detectors or the preventive measures steps will be taken. Then customer communication and support. Effective customer communication and support are crucial throughout the claiming process. A continuous communication must be maintained with the policyholder. Then regulatory compliance. According to the legal regulations or legal requirement only, the claims must be settled as per the protection of the laws, privacy regulations, and other standard legal regulations only. The claim settlement process must take place. Technology and digitalization. Insurers are increasingly leveraging technology to streamline, like the insurance policy holders, they are depending on technology to streamline the claim process, because using a technology, the claim process settlement will be done fastly. Then claim management best practices. The best practices include clear and concise communication, having a proper communication with the policyholders, prompt and fair claim handling, and proactive fraud prevention will lead to the claim management best practices. By implementing these practices, insurers can effectively manage claims, ensuring fair settlements, enhancing customer satisfaction, and maintaining the integrity of the insurance industry. So this is about the claim settlement process, which we can see in the general insurance policies. I hope today's topic is very much clear to you all. Today we have discussed the premiums, claim settlement process in both life insurance and general insurance. Along with that, some of the important elements which we can see in the life insurance policies like surrender value, rider benefits, premium loading. All this we can have in the additional concepts which you can see in the life insurance. I hope the concept is clear to you all. Let me continue in the next class with the further concepts. Have a nice day. We'll meet again in the next class. Thank you.